Welcome to the question clip on Chapter 10. And the question that we are going to do today is the one on Kunik manufacturers. You're welcome to follow in your question book and suggested solutions. Like with any question, we start with the required part. We have two parts to this required. In the A part, they ask us to prepare the general journal entry for Kunik manufacturers for the depreciation that must be provided on 28 February 20.6. Date's very important, and we're doing this at the end of the financial year, which in this case is 28 February 20.6. In the B part, they ask us to show the disclosure of the non-current assets in the statement of financial position as well as the notes to the financial statements, again of Kunik manufacturers for the year ended 28 February 20.6. So we know we have to prepare a general journal. We can get our framework ready for the general journal. Just a column for debits and a column for credits. And we also have to prepare the notes to the financial statements and an extract from the statement of financial position. So our note, that format, very important. This you can write down before you start reading the question so that you have your carrying amount on a specific date. Remember, the start of the year. That's why we highlighted the date. So it's 28 February 20.5. And that we're going to reconcile with the carrying amount at the end of the year, and that will be 28 February 20.6. Now, the carrying amount is calculated by taking cost and deducting the accumulated depreciation in each of the cases. And then the movements during the year can either be acquisitions, disposals, or depreciation. So this framework, once you've read the required part, you can write it down so that we don't waste time with formatting during the question. On the 1st of March 20.5, another important date. Remember, the required part mentioned 28 February 20.6. So this information is provided at the start of the year, 1st of March 20.5. The following information was available from the records of Kunik manufacturers in respect of their non-current assets. So for each category of assets, furniture and equipment, machinery and vehicles, they provide us with the purchase date, the cost on that purchase date. Then they provide us with accumulated depreciation, and that's on the 28th of February 20.5. This is actually exactly the same as the 1st of March 20.5. So they provide us with accumulated depreciation on that date. They give us the method of depreciation, whether there's a residual value or not, the useful life, and in some instances, the estimated number of units to be produced during the useful life. So in the A part, we have to calculate the depreciation. So we will need to, first of all, focus on the method of depreciation for each of the different classes of assets. For the furniture and equipment, which was purchased on the 1st of September 20.3 at a cost of 160,000, we need to use the straight line method at 25% per annum. Now, when you use the straight line method, you need to know the formula that we use for straight line method. So in my calculations for furniture and equipment, I'm going to start by writing out the formula. Now for straight line, we use the cost price. We deduct the residual value, so that gives us our depreciable amount. We multiply that with a certain percentage, and then we apportion it for the amount of months in this year. So we're going to have to apply this formula for our furniture and equipment for the current financial year's depreciation calculation. Now if we can look at the information for furniture and equipment, the cost of the furniture and equipment was 160,000 Rand. So I can include the 160,000 Rand for my cost price. Deduct residual value for furniture and equipment was not applicable. So there's no deduction for the residual value. Then I multiply it with the percentage provided times 25 over 100. And then in the current financial year, additional information number 1 relates to vehicles, and additional information number 2 to machinery. So there was no changes. That means that I had the furniture and equipment from the start of the financial year to the end of the financial year. So that will be a 12 out of 12. And if I can do that calculation quickly, 160,000 Rand at 25% for the whole year, that will give me depreciation of 40,000 Rand. So my 40,000 Rand depreciation for furniture and equipment, that's my calculation. Now the required part didn't ask us for calculations, they asked for the general journal entry. So let's convert this calculation into marks quickly. The debit for depreciation is in the expense account. So we debit the depreciation. This will occur at the end of the financial year, which will be 28 February 20.6. I debit my depreciation, and remember we use one expense account for the depreciation on all the classes of assets. So I will start with my 40,000 in a bracket, and then my credit will go to the accumulated depreciation on the specific class of assets. So I'm going to credit accumulated depreciation, semicolon, furniture and equipment. Just for space purposes that I use the abbreviation, please write out the whole term. Then we can go over to our machinery. Machinery, they tell me, I purchased this on the 1st of May 20.5. Again, I had it from the start of the year, because the start of the year was the 1st of March 20.5. Cost is 660, accumulated depreciation of 78,750, and now the method of depreciation is the production unit method. For the production unit method, our formula, if we can write it down, for machinery, production unit, we start with the depreciable amount again. Cost price minus residual. And then if we divide this by the total units, expected units of production, that will give us a rate per unit of depreciation. Once we've gotten the rate of per unit, we multiply that with the actual units produced in the current year. So using the information to complete this formula, for machinery, the cost price of the machinery was 660,000. So I can include that in my cost price. The residual value for machinery mentioned there as 30,000. That's the guaranteed buyback value. When we purchased the asset, they already informed us about that. So there we have our depreciable amount. We divide that by the total number of units that we expect to get from the machine at the start. Estimated number of units to be produced, 120,000. And then we have to multiply that with the actual units produced during the current financial year. That is not provided at the start of the year, but in additional information number 2, they mention, on the 28th of February 20.6, the end of the financial year, the machinery had produced 18,000 units for the current year. So you will see in our formula as well, we do not apportion this for an amount of months because the time is already captured in the units that was produced. You can only produce X amount of units in the time provided. So if we take our 660,000 Rand cost price minus the residual value of 30,000 Rand, that will give us our depreciable amount. We divide that by 120,000 units, total units of production. That gives us a rate of 5 Rand per unit. And if we multiply that with the actual units produced during the current financial year, that will give us our depreciation on machinery, sorry for that finger troubles, of 94,500. Remember, 660 minus the 30, depreciable amount, divided by 120 times the 18,000 units. We have to earn our marks again with our general journal entry. So in depreciation, we're going to have a debit of 94,500 added to the 40,000 that we already started with. And then we're going to credit our accumulated depreciation on machinery of 94,500. Our last category for the current financial year for vehicles that was purchased on the 1st of March 20.3. So you will see we had the vehicles from the start of the year, a cost of 360, accumulated depreciation of 129,600, and now we're applying the diminishing balance method at 20% per annum. Diminishing balance method for vehicles is our cost price minus accumulated depreciation. We have to multiply that with a specific percentage and then apportion it for an amount of months. So for vehicles, we do not only deduct the residual value in the first year, but we are also going to deduct the accumulated depreciation up until that point before we multiply with a percentage and the amount of months. We had this vehicle purchased on the 1st of March, and in additional information number 1, they tell me on the 30th of November 20.5, that's during my financial year, a new vehicle was purchased on credit from Cars for You at 120,000 Rand. An air conditioner costing 5,000 was installed in the vehicle and paid for on the same day. These transactions have not been recorded. Okay, if this has not been recorded, we know that because they provided us with this information on the 1st of March in any case. Because of the different purchase dates of the vehicles, we cannot combine the two vehicles in one calculation. So we will have to split this into a calculation of the old vehicles depreciation as well as the new vehicles depreciation, applying the same formula but for the different amount of months and the different cost prices. So if we apply this formula for the old vehicles, the information from the table, a cost price there of 360,000 Rand. So we're going to include our cost price minus accumulated depreciation on that vehicle was provided for us on the 28th of February 20.5, which is the start of the year, 129,600. So that's my carrying amount at the start of the year. We multiply that with the percentage that was given as 20. And we had the old vehicles for the whole year, 12 out of 12. If we can quickly do the calculation, 360,000 Rand minus the accumulated depreciation of 129,600. That will give me my carrying value. Then I multiply this with the 20%, It's for the whole year. So that will give me depreciation on the old vehicles of 46,080. That is just for the vehicles that I had from the start of the year. Now I need to do the calculation for the new vehicle as well. They mention a cost price of 120,000 and an air conditioner of 5,000. So we will have to add the two of them together because the air conditioner cannot operate without being installed in the vehicle. So that forms part of the cost of the vehicle. So my new vehicle's cost price is the 120,000 Rand plus the 5,000 for the air conditioner. And then I have to deduct from that the accumulated depreciation. Now, if it's a brand new asset, accumulated depreciation is for usage in our entity. Brand new assets cannot have accumulated depreciation in the first year of use, so that will be a 0, multiplied with the 20%. And then we have to determine how many months in the current year did we use this asset. We purchased it on the 30th of November, so you do not include November in your count, so that will be December, January, February. That will give us 3 months of usage in the current financial year. If you do that calculation, you will get to depreciation of 6,250 Rand. These two amounts will be the depreciation for vehicles added together for the current financial year, 52,330, and we go and earn the marks in our general journal entry. So we add to the depreciation that we already have another 52,330 for vehicles, and we credit our contra asset accumulated depreciation vehicles. If you add the 40,000, the 94,500, and the 52,330, that is your total depreciation of 186,830. The journal narration. Depreciation for the year. And you can include additional information there in practice. So we've now answered the A part of the required, prepare the general journal entry for the current year's depreciation, and now we're going to use this information to also show the disclosure of non-current assets in the statement of financial position as well as the notes to the financial statements. I'm going to use the format that I drew up earlier for the note, because the information in the total column of the note will also be the information that I transfer over to my statement of financial position. So we're going to look for the cost price and accumulated depreciation at the start of the year for furniture, machinery, and vehicles. And most of this information is actually provided in the table in your question. For furniture and equipment, they give us the cost price of 160,000. Remember, this information is on the 1st of March, so I can include that cost price of 160,000 for furniture and equipment at the start of the year. Then in the table for furniture and equipment, they did not provide the accumulated depreciation on the 28th of February 20.5. There we have a question mark. So we still have to quickly do the calculation of that accumulated depreciation before we can include it in our note. And if you recall, for furniture and equipment, we said the formula that we're going to use is the cost price minus residual times a percentage times an amount of months. We do depreciation calculations at the end of every financial year. So now we have to determine for the furniture and equipment from the date of the purchase until the first financial year end, what was the depreciation for that period of time. So from the 1st of September 20.3, that was the purchase date. The first financial year end would have been 28 February 20.4. Then we're going to have another financial year which started on the 1st of March 20.4 until the start of our financial year, where we want the accumulated appreciation to include it in the note, 28 February 20.5. And we apply the same formula. So in this case, it will be the 160,000 cost price minus no residual value. The percentage is still 25. And now from the 1st of September until 28 February, if you count, that will add up to only 6 months, leaving me with depreciation of 20,000 Rand for the period 1st of September until 28 February. Now I need to do the same calculation. Because it was straight line, I only use cost price minus residual at 25%, and this is for the whole year. So that will give me 40,000. This is the period from the purchase date until the start of the financial year, and these two amounts added together will give me 60,000 Rand accumulated appreciation as at the start of the year. So in my notes, I can include the 60,000 at the start of the year, accumulated depreciation. Remember, that's deducted from the cost to get to the carrying amount of 100,000 Rand at the start of the year. Movements during the year, I didn't acquire any new assets. I didn't dispose of anything. I just used it for the current year, and we did that accounting entry as well as the calculation. There was the 40,000 for furniture and equipment calculated in my calculations. So I'm going to include the 40,000 as depreciation. So now 160,000 cost plus no movements influencing the cost will give me 160,000 cost price at the end of the year as well. My accumulated depreciation, I started off with 60,000, and then I added depreciation of 40,000, resulting in accumulated depreciation of 100,000 at the end of the year. That's 60,000 plus the 40,000, resulting in the 100,000, leaving me with a carrying amount at the end for furniture and equipment of 60,000. If we do the same process, follow the same process for machinery. Machinery, they started off with a cost of 660,000 at the start, so we can include the 660,000. Remember, they mentioned a residual value, but residual values will not be accounted for until they are realized. We just apply these in the calculations. So no accounting entries for the 30,000. We just use the cost price. Accumulated depreciation at the start was provided as 78,750. Which is deducted from the cost price to get to the carrying amount at the start of the year, 581,250, 660 minus the 78. We didn't have any acquisitions during the year. We didn't have any disposals during the year, but we did do a calculation for depreciation for machinery. In our general journal entry for this year, it's 94,500. Cost price at the end is the 660 plus or minus none of the movements influencing the cost price. So I will end up with the 660,000 at the end of the year again. That's 78,750 plus the depreciation for the current year will result in my accumulated depreciation at the end of the year, 173,250. And the cost price minus the accumulated depreciation will will give me my carrying amount of 486,750. For our last class of assets, we had additional information number 1 as well, where we purchased a new vehicle. So we're going to follow the process, starting from the cost price at the start of the year of 360,000 Rand. So we can include that in our cost price. They again provided us with the accumulated depreciation for vehicles at the start of the year, 129,600. And the cost price minus the accumulated depreciation will give us our carrying value at the start of the year of 230,400 Rand. So we've completed the carrying amount for all the assets at the start of the year. We had acquisitions of vehicles. Not only the 120 purchase price, but also the air conditioner that we added, 5,000 Rand. So the total cost price of the acquired asset will be 125,000, which I add with my acquisitions. I didn't have any disposals of vehicles, but I did do a depreciation calculation for both the old vehicles and the new vehicles. So remember, in your depreciation entry over here, it can be a combination of a number of amounts. So we added the two depreciations together, 52,330. And now we need to use the movements and the opening balances to get to our carrying amount at the end. We're going to have to take the 360,000 that we started off with as a cost price and add to that the 125,000 cost price. So that will give us our cost price at the end of the year, 485,000 Rand. And then we take our accumulated depreciation at the start, plus the depreciation on both the old and the new vehicles, and that will result in our accumulated depreciation at the end of the year of 181,930. So for each of these line items, you will also calculate a total. I'm just going to show you how we get to the total of the carrying amount at the end of the year, because we need this value for carrying amount at the end of the year so that we can include it in our statement of financial position. This amount for depreciation will agree with the total depreciation in the statement of profit or loss. So we start off by calculating the total cost prices, furniture and equipment plus machinery plus vehicles, and that will give us a total cost price of 1,305,000. Add together all the accumulated depreciations on all the classes. And then the total cost price minus the total accumulated depreciation will result in a total carrying value. This is the value that will be disclosed in the statement of financial position at the end of the year. And you will carry on with the totaling of all the other columns as well. So this 849,820 will have to be disclosed in my statement of financial position as at a specific point in time. This is classified as a non-current asset, and we use our terminology from the International Accounting Standards, property, plant, and equipment. So I'm going to include my 849,820. And the users can see the details of that amount if they look at note number 2, which we compiled already in notes to the financial statements. So that is the disclosure and the calculation of depreciation and other aspects regarding property, plant, and equipment, my non-current assets. Please join us again later for further video clips on this chapter.